All right, gold and silver prices, along with broader equity markets, are down. Now, on Friday, we touched on a major cause being real interest rates making a beeline back to the upside, though still in negative territory. But today, I want to provide an even deeper dive into this issue, especially given the stimulus news not having much of an impact on markets. So, in this video, I will show you why the recent inflows into equity funds has actually pushed markets to the downside. And we'll also even look at that same behavior within bond markets because that will actually tie us right back into gold and silver's price movements. Now, upon hearing this, you may be skeptical because you'd think that it would be a boon for equities like they were in the 90s for inflows to go into equity funds. But scientists in Israel have noticed a behavioral change, and we'll talk more about that later. But first, let's start with this opinion piece here on Market Watch. And it's titled, What Money Flows and Mutual Funds Really Say About the Stock Market's Future. So I'm just going to read this brief blurb here. And I quote, according to data from EPFR, a division of Informa Financial Intelligence, last year was the fifth in a row in which investors took money out of U.S. equity funds. Indeed, as you can see from the accompanying chart, there were net inflows in just 2 of the last 10 years. So take a look at these outflows from U.S. equity funds, both open-end and ETFs. It's all red pretty much, with only 2 years here of inflows. Now, it continues. All told, a net 444 billion was pulled out of the U.S. equity funds and ETFs over the past decade. During that period, the S&P 500 produced a cumulative total return of 250%, equivalent to 13.6% annualized. Clearly, net outflows during a bull market are the rule rather than the exception. It continues, should you conclude from this that there is more than just a correlation between outflows and a rising stock market, and that the former actually causes the latter? No. Consider an academic study that appeared a number of years ago in the Journal of Financial and Quantitative Analysis. The study's authors were Avi Wohl, a finance professor at Tel Aviv University, Azi Ben Raphael, a finance professor at Rutgers University, and Shmuel Kandel, now deceased, who was a finance professor at Tel Aviv University. They found that mutual fund inflows have, at most, only a temporary impact on the stock market. So that's the big thing here, guys. This is going to be temporary. Keep that in mind. And we end with this. That is just another way of saying that their impact is quickly reversed. How quickly? Within 10 trading days. So let's take a look into the study a little bit more and see what these scientists had to say about why this happens. So here is a piece of the study. You can actually find it if you go into Google Scholar and basically type in the title of this study. I'll give it to you right now. It's The Price Pressure of Aggregate Mutual Fund Flows. And you can take a look. Here are the authors' names. You can take a look at it. It's really interesting stuff. But I'm only going to talk to you guys about a couple of hypotheses as to why this happens. Now, these are the two that they mainly found could be undergirding this. The first hypothesis is the information hypothesis. Good or bad, news regarding the equity market leads to positive or negative returns and to flows into or out of equity funds. Now, here's the second hypothesis. The second hypothesis is the return chasing or feedback trading hypothesis. Investors react to lag returns with positive or negative returns, leading to positive or negative flows. Okay, so guys, let's recap. Inflows into equity funds are correlated with temporary downside pressure into broader equity markets. And a couple of these Hypotheses as to why come from positive or negative information and or return chasing trading. Now, the interesting thing is that this behavior can also be found in bond funds as well. Now, this is going to take us into last year as we saw the rapid rise in the stock market with in 2020. These researchers here are saying that inflows into bond funds were actually helping equities, while there were actually outflows happening within equity funds. Again, tying back to that behavior we just talked about with those outflows of equities boosting the performance. Now, here's a quote here. The stock market's incredible rally over the past couple of months has not been fueled by transfers out of bond funds and into stocks. On the contrary, according to data from EPFR, a division of Informa Financial Intelligence, that same division, fund flows over the past 8 weeks have gone in the opposite direction. US equity funds, both open end funds and ETFs, have experienced total net outflows of $11 billion, while US bond funds have seen net inflows of $95 billion. Here's the chart below that they're talking about that you can see. This is from last year, guys. Remember, here are the inflows of bond markets in the green of bond funds, and here are the outflows that you see in equities. Now you do have some inflows here, but you see a lot of outflows here. So let's continue. This would appear confounding since stocks and bonds are typically seen as uncorrelated assets. However, it's important to view the inflow-outflow data from a contrarian mindset. That's key, it's contrarian. The outflows portend only to short-term movements. We talked about how these movements were temporary before, and subsequent flood of inflows would result. Here's a quote. This comes as a surprise to many since conventional wisdom teaches us that rallies are propelled higher when money on the sidelines is seduced back into the market. But the conventional wisdom is wrong, according to researchers. Fund flows actually are a contrarian indicator. So while fund inflows are associated with an immediate boost to funding prices, that boost typically only lasts a few days. Over the subsequent several months, it usually reverses. So again, this is temporary movement here. So let's see how this applies to what we've been seeing in recent weeks. So here we have a graph of fund flows. The orange bar represents equities. Starting on the week of February 10th, right here, inflows skyrocketed within equity funds. And they've continued to do so in some degree, though we've been seeing a downward trend. But look at how high and how much we've seen inflows into equity funds. Now remember, this is a contrarian indicator. So what have we also been seeing within recent months, or recent weeks, I should say, within equities? Well, here is the S&P 500. I'm going to go back to, let's look at 3 months here. Today, we're at 3,861. Okay, so let's take a look at where we kind of peaked here within this 3-month graph or range. So we peaked right around February 12th of 2021. Now, in that graph I just showed you, we saw a large amount of inflows on February 10th. And of course, things have been kind of oscillating to the downside. But as you see here, the S&P 500 has been coming down since that peak on February 12th. Again, here's that graph. February 10th is when we saw all those inflows. Now, let's relate this back to the bond market. And let's take a look at when real interest rates started rising. So here's a graph of the 10-year inflation indexed. So as you see, we're still in negative territory, which is good for gold and silver. But let's take a look at recent weeks. Here's just January of 2021, and we're going down. right here, we hit an inflection point. Funny enough, on Wednesday, February 10th, we hit this inflection point at negative 1.06. And then what happened right after? Boom, a rise to the upside for real rates. So real rates have been rising, giving pressure to gold and silver prices, pushing them to the downside. Now, remember, as we've been seeing flows going into equities, we've somewhat also been seeing some selling of, or better yet, a trend here of outflows from bond funds. Now, this is essentially the opposite of what we saw from that research, where we saw inflows. So the trend was kind of going up for inflows into bond funds, while we start to see outflows here in equity funds. And this is the combination that we saw helping to boost stock markets in 2020. One of the reasons why we actually saw real rates come back down again. So let's go back to that graph. So this goes from April 16th to around June 4th of 2020. So going back to 2020, let's go to April 16th. We're right around here. We're hitting like a peak, and then we're starting to see somewhat of a downtrend going into May. So we're seeing a downtrend going to May, going into June. There's a little bit of an uptrend here. But generally, we have a downtrend. And then, of course, we see even more of a downtrend that happens during that time. As we know, that helped gold and silver prices really go to the upside. This huge, steep decline here. And during that time, we saw equity markets, start to go to the upside rapidly as well. We start to see them hit huge records. So as we see real rates go to the upside, what we should also take note of is that we're seeing inflows going into equity funds. And we're starting to see some outflows coming out of bonds. But here's something to take note of. We're starting to see a little bit of a trend or a decline in the amount of inflows going into equities. And we're actually starting to see, hey, look, there's an inflow here going into money markets. So hopefully, if this trend continues and we maybe start to see something like this happen, as you see, you have some inflows coming in here in bond markets, and you have an outflow here, or not outflow, but just a huge decline of inflows going into equity funds. Hopefully, we can start to see some behavior that will be beneficial to gold and silver prices and just broader markets in general. So guys, let me know what you think about that study I showed you, the price pressure of aggregate mutual fund flows. If you guys look into it, let me know if you do. Thanks again for watching. Please hit that like button. Please subscribe if you're new. It's Black Bullion for gold and silver today.com.